Organic investments have been focused towards investing in R&D, primarily for our U.S. markets. In respiratory, we have filed 5 assets, including Symbicort and generic QR, with launches expected within 3 years. Further, we are targeting to file 2 respiratory assets with significant revenues in the next 12 to 15 months. In peptides and complex generics, 12 assets were already filed, with most launches in 2 to 4 years. As alluded earlier, we strive to launch 4 peptide assets in FY25. We are also working on several 505(b)(2) opportunities and complex ANDA products, which are currently in development and will be key to our future portfolio. For our organic partnerships and investments, we have been very mindful of the choices to allocate capital. Earlier this year, we invested in Actor Pharma, which stands fully integrated as on date and is expected to help accelerate our South Africa OTC portfolio in FY25. Recently, we entered into a marketing and distribution partnership with Sanofi to expand the reach of CNS portfolio in India, in line with our focus to enhance our chronic portfolio. In Cipla Health, we entered into a brand acquisition for the cosmetic and personal care business of Ivia Beauty Private Limited, which includes their flagship brand Asterberry, to bolster our India OTC portfolio. During the year, we disinvested our QCIL portfolio and focus on allocating our capital to other growth projects, while we continue to serve Africa through our global access business. In the past year, the U.S. FDA audited 3 of our facilities based in the U.S. and issued either a VAI or 0483 observations. Our new facility in China, which has capabilities in manufacturing respules for local markets as well as the U.S., also cleared the U.S. FDA audit with 0483 observations. We expect to start supplies of the respules to U.S. from China, a strong demand, in the second half of FY25. Meanwhile, our Goa Unit 5 unit cleared GMP audit by the MHRA UK earlier this year. Recently, 2 of our facilities at Patalganga and Kurkum also underwent the US FDA audit. The Patalganga facility was issued with 643 observations, and the Kurkum audit ended with 1 observation. We await the official classification for both sites. In Goa, we have now finished remediation activities and are ready for the US FDA audit, while at Indore, we are focusing on getting the plant remediated. I would now like to invite Ashish Adukia to present the financial and operational performance.
Thank you, Mark. I would like to now present key financial highlights for the quarter and financial year 2024. To clarify, the numbers are adjusted for QCIL disinvestment, which was completed earlier this year. We are pleased to report a quarterly revenue of 6,163 crore, with a healthy YOY growth of 10% driven by our focus markets. As a result of this quarter, we ended the year at 25,455 crore, with revenue growing 14% YOY. The EBITDA margin for the quarter stood at 21.4% versus last year of 20.45%, almost a 100 basis points improvement. And for the year, the EBITDA margin was 24.5% as against last year of 22.2%, again a 200 basis points beat. Gross margin after material costs stood at 66.7% for the quarter, which is 192 basis points over last year. The gross margin for the year is at 66%, higher by 200 basis points YOY. Expansion in profitability is largely due to favorable mix, calibrated price actions across branded and generic portfolio, and impact of easing cost inflation. Total expenses for the quarter include employee costs and other expenses, which stood at 2,797 crore, higher by 6.7% on sequential basis. Annually, the expense were 10,572 crore, higher by 13% YOY. R&D investments for the quarter are at 444 crore, or 7.2% of revenue, against our yearly average of 6 to 7%, driven by product filing cost and developmental efforts higher in the quarter by 19% versus last year. Overall, for the year, the R&D investment stood at 1,571 crore, or at 6.2% of the revenue. Profit after tax for the quarter is at 939 crore at 15% of sales, ETR at 25.8%. Full year profit after tax stands at 4,106 crore at 16% of sales and ETR at 27.1%. Our capital investments for the year were 1,315 crore, out of which 70% was invested towards growth and improving our capacities and capabilities, while the balance was deployed towards maintenance and sustainability. Free cash generation and operating efficiencies has resulted in a healthy cash position, as at the end of the year, the gross debt on our balance sheet is 559 crore, which also constitutes the lease liabilities and working capital facilities. Cash equivalent balance as on the date stands at 8,267 crore. Looking forward, our key focus areas for FY25 will be growth for One India, led by RX, where our aspiration continues to grow higher than IPM, backed by chronic portfolio. Efforts in trade generics will be channelized towards smooth transitioning to the new operating model for a long-term benefit. This may have an impact for a quarter, but over the year, we hope to recover. Cipla Health should be back on its growth trajectory after a difficult year impacted by seasonally slower demand. In North America, the aspiration will be to grow up top line YOY, primarily backed by commercial execution of existing portfolio and new launches. We remain focused on resolution of US FDA observations, de-risking our product launches. We would continue to explore inorganic partnerships and acquisitions. Growth in South Africa supported by private and select tender business with priority on margin improvement. In EM/EU, the top priority is to improve top line while margins are maintained at a sustainable level. ROIC continues to be very healthy at around 31% for the last year. We aim to deploy 1,500 crore in capital investments to enhance our manufacturing capability and improve sustainability. EBITDA margin for the full year is expected to be up to 100 basis points over last year, which should result in the range of about 24.5% to 25.5% EBITDA margin. I'd like to thank you for your attention and would request the moderator to open for the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Saion Mukherjee from Nomura. Please go ahead.
Yeah, hi. Thanks for taking my question. So just can you explain the dynamics in the trade generic segment? You talked about some restructuring on the channel. What exactly is that? And, what's the impact, you expect in the first quarter here? And secondly, what's the total contribution to the One India number from the trade generics? And, given that many players are focusing on that in this segment, if you can comment on the dynamics evolving here? Thanks.
Sure. See, on trade generic, on the model change that we're talking about is that we used to earlier have a sole CFA agent, which used to earn the commission, and they used to handle the collections as well as inventory, etc. Now what we have done is that that converts into only a marketing agent. Okay, so it will only be a commission, and we'll directly deal with the stockists underlying that sole agent. So we will have direct connect with the stockists now. Now this requires a little bit of administrative changes, etc., due to which there can be some hiccups in the first quarter as we transition with the direct connect. But over a period of time, like I said, it will ease out to normal growth. On the second question, the split, we don't give that split. It's the same split as both have grown trade generics slightly higher than the RX market. So the split is broadly same as has been in the previous year.
Yeah, maybe I can add, Ashish, just a couple of points. So, Sayan, the attempt is to move closer to to trade in generic. We'd like to actually consolidate distribution across our RX and GX, and we think that by us taking the operation over, we will be able to move closer to trade. And that's the change that's happening in GX. I think if your question is how much is it going to be an issue in a quarter, not significant enough for us to get concerned right now. There might be some impact as inventories get reshaped, but not significant for us to be worried at all. I think on your next question, just very quickly on the generics business is also a branded business. We have to fundamentally understand this. Medicines don't sell as trade generics, as GX. They sell as still branded GX. And I think the dynamics of that business are still highly dependent on the brands you sell. So as long as there's brand saliency, competition may impact you, but our thesis of big brands going bigger continues to shape the trajectory of that business.
Okay, thank you. Thanks.
Thank you. The next question is from the line of Kunal Randeria from Axis Capital. Please go ahead.
Hi, good afternoon, sir. So my first question is on your inorganic investments. So while you've kept the door open and you want to be judicious about it, a few years back you had made some forays in semi-specialty products like IV tramadol, pulmazole. So while I understand it didn't work out, are you still keeping your options open? And if so, perhaps you would like to maybe tell us which kind of assets you would be interested in and the amount that you would be comfortable investing?
Ashish Bhai, maybe you can answer that.
Yeah, sure. See, I think, with India, we are fairly comfortable with the growth, etc., that is available in the market. So we can make a large acquisition in India to make sure that in the white spaces, the therapies, etc., which is our focus areas, where we're not a leadership position, we will go ahead and we can make large acquisitions out there. When it comes to U.S. Portfolio or partnership or in-licensing products, etc., there I think it won't be a large acquisition, and it will be a lot focused on products where there is some differentiation available. Either it could be supply constraint or lower competition due to many reasons. I would be interested in such opportunities out there. so that it has a longer life in the market. Umang, if you want to add, please go ahead. Yeah.
No, I think what you've covered is great. I think that's very elaborate. Thank you.
Sure. Thanks. My second question, with so many players coming in trade generics in India, how do you see this market shaping up? Because at some point it will cannibalize, it has already started to cannibalize the branded market for the industry. So just your thoughts on how the market will shape up in the next 2 to 3 years?
Actually, I have a different view on this, and let me offer it. We don't see more than a 20% overlap between what sells in the tier 2 to 6 cities in our generics business versus what sells in these cities from our RX or prescription business. There is very little of the prescription business that filters down to tier 2 to 6 towns. And therefore we believe that the generic business, as penetration of healthcare deepens, is only going to expand in volumes. It's not going to decrease. Having said that, as I mentioned earlier to Sayan, the business is still a branded business, and the salience and relevance of brands is very important. So the older the brand and the more current the therapy, the business will continue to grow. And over the last 2 years or 3 years, we have been diversifying ourselves away from a pure chronic orientation in this part of the business. So we feel, competition is good. It will drive definitely growth higher. But we don't see this business as cannibalizing the branded business in any way, the branded prescription business in any way. That's number one. Number two, we think the market is big enough to drive further penetration through the competition activities. And three, businesses which have been historically present and have large branded franchises, because that's essentially what the generic business is, are actually on a firmer ground compared to some of the newer entrants.
Got it. Okay. Thanks for answering my question, and all the best.
Thank you.
Thank you. The next question is from the line of Nitesh Dutt from Burman Capital. Please go ahead.
Hi. Thanks for the opportunity. Sir, I have a question on the manufacturing strategy of our India business, both the prescription and trade generic side. So what percentage of the manufacturing is currently being done in-house and what percentage is outsourced? And will you be maintaining the same mix going forward? And second, also want to understand if for the outsourced portion, is that fragmented across a lot of suppliers or consolidated amongst a few top players?
So I'll try and give you an answer. I think we have a larger share of the prescription business manufactured in Cipla facilities than the generic business. I think we have strategic partnerships with a lot of people, some of whom consolidate with us, and typically it's easier to consolidate manufacturing in OSD units than it is in injectable facilities, than it is in dermatological facilities. So I think we have a strategy of consolidating facilities here, but in-house facilities supply a much larger share of our prescription business and than the generic business. But in-house facilities supply both businesses as of today.
Or is it possible to give any number on what percentage might be getting outsourced and what is getting manufactured in-house?
So I can give that to you. The only issue is that it varies quarter by quarter. And the reason for that is that it's seasonal. So when we see a huge amount of the respiratory season, most of that comes from in-house. When we see a season which is more, chronic heavy, again, a large portion of that comes from in-house. So I think it's difficult to give you a picture other than just perhaps say that a larger share of our prescription business comes from in-house than the generic.
Understood. And so finally, the government has been placing a lot of emphasis on cracking down upon some of the smaller CMOs, etc., and focusing on stricter implementation of schedule and norms, etc. So, can it impact our procurement strategy or contract manufacturing in any way?
I think
consolidation or increasing the procurement cost.
No, it's a great question. I think by and large the industry and the IPA is moving to facilities that have as a minimum WHO approvals. So that's the first step that started happening. So if there's a facility that at least has a WHO approval, it's going to be preferred. If it's got an approval which is, WHO plus Europe plus something else, then obviously that's gold standard. It starts getting closer to gold standard. So that's one that most companies are now looking at. And this will hopefully push the standard of manufacturing in the Indian diaspora. The second is a more heightened oversight of quality, including release tests, etc. at these facilities, where most companies are now adding a lot of requirements. And more spontaneous quality checks, including audits by, including unannounced audits by the respective companies. So I think those are the two models that perhaps are immediately impacting the industry. But I think I'll leave it at that.
Sure. Thanks a lot for this. I'll come back in a bit.
Thank you. The next question is from the line of Kanha Agarwal, who's an individual investor. Please go ahead.
Sir, why is there an increase in the other expenses for the quarter versus Q3?
I'll request Ashish Bhai Aditya to answer.
Thank you, Mansi Vora. That has manufacturing cost, that has S&D, that has even CSR sitting out there. So it has many items out there. So, R&D also is sitting there. So there's increase in R&D because of one of the filings also that we have made. So it's due to these combination of reasons that we have a increase in the cost out there.
These should subside in the next quarter?
Yes, absolutely. It will. So quarter on quarter, this can change. But if you look at the entire year, it is going to be in line with the sales growth. And we maintain the percentage, that discipline is maintained.
Okay, sir. Thank you for answering my questions.
Thank you.
Thank you. The next question is from the line of Damayanti Kerai from HSBC Securities and Capital Markets India Private Limited. Please go ahead.
Hi, thank you for the opportunity. My first question is, you mentioned in your presentation 12 assets were filed in peptides and complex generics, which would likely see launch during 25 to 27. So just want some more color on the market opportunity for some of these critical assets and whether these will be manufactured in-house or you'll be getting it done through CMO.
Yeah, so peptides, all of our peptides is manufactured by our third-party partners. And on market opportunities, there are, some of them that can be large opportunities, like in case of our current portfolio. But there's a long tail as well.
Okay, so mix of some significant assets plus smaller assets here. Okay, and just coming back to US, so with 900 million of base now, you mentioned you will sustain growth, but whether for that new launches like your Abraxane, etc. should come in, or you believe current portfolio has significant headroom to sustain growth from this 900 million base, even for FY25?
Sure.
Yeah, I think Go ahead, Ashish. Go ahead.
Please go ahead.
Okay. So, Yeah, I think we think the current portfolio has opportunity within the set of products, because as we mentioned, we think albuterol can be slightly higher in share. We think that lanreotide can still increase its share. And so I think there is a fair amount we can build out of the current portfolio, but also from new launches. I think the step function jumps in growth will come more from new launches. So we will have a very normalized growth rate from existing portfolio, but the new launches will add the step functions to it. So both. The answer would be both.
Okay, that's helpful. And my final question is, any update on Goa plant from FDA side, when they would likely come? And do you still expect Abraxane to potentially see launch in this fiscal itself?
So the timing of Abraxane is going to depend on the Goa inspection. Goa is the earliest path for a launch. I think so if it can happen early part of the year, there's a good chance for Abraxane to be in the later part of the year, maybe not. So it's all linked to the Goa inspection. We think the Goa inspection, from our last inspection, we will be completing roughly about 2 years in July, August of this time frame. So that would, around that time or beyond it is probably the time to expect a re-inspection.
Okay, so most likely in first half of this fiscal, if FDA visits the unit, then there's a good chance Abraxane will come this fiscal.
Yes, I would say that, but I think please keep in mind an inspection needs to happen. Then there is a 90-day process post-inspection for a company to respond, and then the EIR comes, and then the asset has to be approved. So just factor that timeline. It's very sensitive to when the plant is audited.
Okay. Thank you for your response and all the best.
Thank you very much.
Thank you. The next question is from the line of Surya Patra from Phillip Capital India Private Limited. Please go ahead.
Yeah, thanks for this opportunity, sir. My first question is about the potential business opportunities in the specialty areas. Earlier we have already talked about biosimilar alliance and spending towards CAR-T kind of therapies, mRNA. So is there any update on that side, or are we seeing any kind of meaningful progress on those front as a growth driver for our future business?
I'm happy to answer on that, and Ashish can add. So we are beginning to see to make choices on capital allocation in that side, and it's not so much with the perspective of the next 1 to 2 years, but really the transition of medicine that's happening where biological sciences are perhaps becoming more and more relevant in the field of pharmaceuticals. So, we are now in the process of setting up an mRNA lab in Germany. That process has started. We have recruited a few members of the team. Our biosimilar asset is now hopefully going to enter phase 1 soon. Which is an asset that is likely to launch around the 2030 time frame. And that's one asset that we're working on, and there are a few others. And on CAR-T, we are evaluating what we can do in that space as well. So this whole area, along with our investment in Stempeutics, is the new area of science which will become relevant 5-7 years later in the area of medicine. And I think we want Cipla to have a chance to be able to play a formidable role, just like it does in the chemistry side of the world, but also to play that role in the biology side of the world.
Okay. Yeah, thank you, sir. My second question is on the, let's say, since it is the fourth quarter full year call that we are discussing, so can you give some sense, respiratory as a portfolio, what would be its revenue share, let's say, for US and for your global business? And since our developmental pipeline is also focused around it, so let's say over next 3 to 5 year period, what is the revenue mix that you would like to have from this respiratory portfolio?
Overall, if you look at our respiratory across global revenue, it should be somewhere around circa 30%. That's the kind of share that we have. And in the U.S., it's the Respules, it's Albuterol. These are the key products that we have. Arformoterol. These are the key products that we have in respiratory. And then, of course, we talked about Symbicort and QR and some of the other products also that we are working on. So respiratory is certainly we are leaders out there, and the whole idea is to retain and grow that leadership in all the markets where we are selling these products.
Okay. So just an update or a clarification rather, in terms of the lanreotide, see, we have certainly seen a kind of steady progression, but is there any risk that one should think about the pricing situation, or is there any risk to the current pricing that you are having for lanreotide?
So it's a two-player, broadly a two-player market.
Correct.
As we see it. So, depending on the other player, the prices may vary. But we look at it as a total value that we have, and the whole idea is to actually grow that value this year.
Okay. On your permission, sir, just one clarification. So, what is the update on the inhalation line that you are trying to set up in US? Whether it has been set up already?
Yeah, no, that's underway. This was part of our de-risking plan to actually set up these lines in our Fall River facility. So basically our Invergent facilities that we have across two locations. And one of them will be more focused on inhalation, the inhalers assets that we have, which we are filing for the approvals. This is part of the de-risking. It's very much on track as we speak.
Sure, sir.
Yeah, Ashish, can I maybe just clarify a little bit more on that? So two lines, as Ashish mentioned. The first is a line for NBI, where we have already taken reg batches for several assets, right? And the line has been, approved by the FDA, and the plant has gone through an audit possibly 2 times already. The second is a new facility for DPI, which is coming up, and where the equipment qualification is happening now. Feasibility batches are being taken. That's for the DPI.
Yeah. Sure, sir. Thank you. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Firstly, also, there has been some news flow about this GST relief coming through. Any thoughts on this?
No, we've not got any specific GST incentive circular relevant to us.
Okay. Secondly, sir, just to know how much the investment you would have done for the facility in China?
About $40 to $50 million, somewhere around that zip code. And it's got its approval now, and both for the facility as well as for the product. USFDA approval.
And how many more products do you intend to file or awaiting approval from this side, if you could give some more color?
Sorry, your voice.
Let me take that. I'll take it. I think what he's asking is how many products do you expect to file from the facility. I think this facility is only a Respules facility. So our strategy is to, there are fewer rescue products than many other OSD products. We will file rescue products which are basically steroids, but we would also be filing products where it's taking the same product to multiple geographies where we can service the demand.
Understood. So given that the cash continues to build up in the balance sheet, and while the investment, let's say, in the new areas, let's say in biosimilars, is relatively smaller, is there any thoughts or strategy in terms of adding new geographies per se, apart from India, North America, South Africa?
No, so we don't have any, we already operate in many countries, so we don't have any strategy to add a new geography. We will look at some of our key markets, grower markets and international, where we want to go deeper. And definitely China would also feature in that. Now we have a facility there. We're looking at growing that geography for ourselves more than what we are today. Other than that, there is no really active strategy to look at more geographies. In terms of your question around capital allocation, we have stepped up the dividend by, from 8.5 rupees per share to almost 13 rupees per share. And beyond that as well, I think the whole idea is to focus on some large growth opportunities, not just smaller investments, but large M&A growth opportunities that we have. So we are actively looking at many growth opportunities which should consume some of the capital that we have.
Understood. So just lastly, from a capital allocation point of view, over, let's say, next 2 to 3 years, how much you intend to invest in the biosimilars, both product development as well as, let's say, building the manufacturing capability?
See, it's difficult to give out those numbers. So we have already indicated that currently we're working on one global biosimilar asset. We have plans to add more, and as you may know, how much it takes to per asset in terms of development. So it's difficult to give a number to it, but we always look at the new horizon growth to be core part of our strategy, which includes biosimilar, specialty, CAR-T, and what Umang had talked about, shift from chemistry to biology.
Understood. Thank you.
Thank you. The next question is from the line of Amay from JM Financial. Please go ahead.
Yeah, thank you for taking my question, and congratulations on a good set of numbers. I have first question on the EBITDA guidance, which was given in the opening remarks, around 24.5% to 25.5%. Does this guidance include the higher sales of Revlimid in FY25 or FY24? And the second question is on the Sanofi tie-up, which we have done for CNS products. If we can give more color on this tie-up, are these complementary? Are these products complementary to our portfolio? And also, what was the contract structure for these kind of products? Thank you.
So see, this is an overall EBITDA guidance that we're giving of 24.5% to 25.5% across all markets. And on your second question on Sanofi CNS portfolio, that's something that as per IQVIA, it's about 250 crore of sales for us. And the whole idea, what we've been mentioning, that therapies which we have identified as our focus therapies, we would like to increase our share because that helps us in a longer term to not just gain share but have better growth as well.
But will these contracts will be like royalty driven, or you will be getting markup? Like how would be the profitability for these kind of contracts?
Sorry, so I have one correction.
Let me take that. Ashish, let me take that question. But complete your point.
I said 250 crores, 150 crore IQVIA, Matt. Go ahead, Omar. Sorry.
Yeah. No, so these will be very typical to licensing arrangements that we have on other products. There's going to be not much difference in the terms here versus the others. But I think what it adds a strategic value to us is the ability to be present in a category of products where we believe that, for example, we are very strong in epilepsy, and we aim to become stronger in neurology. And I think there are products like this which allow us to complete the offering in the CNS space.
Got it. But the cesium is for epilepsy, right?
That's what I'm saying. So epilepsy and neurology. That's where we want to be in the CNS space. So, for example, within the CNS space, at this point, we don't have either the portfolio or the muscle power to compete with others who have stronger portfolios in the psychiatry space, for example, right? Or even in the Parkinson's space. But our portfolio is more present and allows us to compete in the space of epilepsy and possibly other conditions of neurology. So that's why this portfolio was important to us in those categories.
Got it. And just one more follow-up on the first answer on the overall guidance. The reason I'm asking, because the incremental sales, if you assume the 10% kind of a growth next year, for that kind of a margin, the incremental sales would be coming at around 30% plus EBITDA margin, 35% plus EBITDA margin. So it will need a good amount of sales from high margin products. So that's why I was asking whether the Revlimid increase in sales is assumed in this guidance or no.
So we have certain cost measures also. There is overall, focus on improvement of cost as well as other costs as well that we focus on to try and achieve the margin that we have guided towards.
Sure.
Yeah, I think the answer will be yes. The answer will be yes. It is fairly comprehensive of what we think we can achieve based on various factors that are coming. I think one of the things that we are also guiding towards is a sharper investment in India and the field force. We will be expanding our field force in India, and I think the numbers that we've indicated to you are the consummate number of that.
Sure. Thank you so much. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
US will have 2 more years of reasonable Revlimid contribution. With whatever growth plans we have in place, how do you see a potential F27 be? Do we have enough levers in the business to grow beyond whatever we do in 25, 26, and 27 on top of that?
Yeah, maybe I could go first and then Ashish can comment. I think, while we have Revlimid in our numbers today, we are also constrained by the inability to launch several products from our facilities due to their citation. And some of these products are fairly, can be fairly material to the trajectory of our company. So I think that's the first thing that we should just keep in mind, that as some of these facilities become citation-free, there will be an opportunity to launch those portfolios. The second, as Ashish mentioned, we're also preparing for a post-Revlimid scenario, which includes not just pipeline and portfolio, but also a fair and significant amount of effort for the organization on the cost front, and that exercise has started. The third aspect is we continue to see robust growth in India, and a large portion of that growth hopefully will stay and continue to stay profitable as we expand into the interiors. So we are seeing growth coming from there. We are seeing growth coming from our emerging markets and EU franchise, which has historically been flat. And we see a pipeline that will support the rev limit going away, some of which is pending just inspections, some of which is actively under review, along with our cost program. So that's how we look at our business transition.
Thanks. And just on that, you mentioned about, I think, a previous call, a largish launch coming through in Q1 on a peptide. Are those plans still on track for that launch?
Yes, they are.
Okay. And if I can, the last one, you did mention a little bit in your comment about emerging markets in Europe. Relative to peers, this has been a relatively underperforming segments for us. How do you see, is there anything that we are looking to do to incrementally move up the momentum here? And where do you see these two segments really moving forward?
So, the problem with emerging markets over the past 3 to 4 years has been Cipla's presence in a lot of geographies which got impacted by the, by the economic environment in the world. Where we are today is that we believe most of these have bottomed out. And we see that this is a very good base to possibly show growth now going forward. Also, our pipeline in Europe should hopefully unlock. We've been building that over the past 2 to 3 years. And so if you add those two together, while we're not guiding to say that the business is going to treble or double, or that's not where we are going, but I think we should hopefully be able to see a respectable double-digit growth in this segment.
Thank you.
Thank you. Ladies and gentlemen, we'll take the last two questions. The next question is from the line of Kunal Dhamesha from Macquarie Capital. Please go ahead.
Good evening and thank you for the opportunity. So the first one on the revenue growth, have I missed something as to what our expectation for in terms of revenue growth for FY23?
So we do not give revenue growth guidance, but certainly for our core markets of India, US, as well as South Africa, and then especially India and South Africa, because that's actively tracked and IQVIA, we would like to grow faster than the market, and we are guiding towards that.
Okay. And in terms of the R&D expenses for the next year, how do you expect to trend? I think this year was 6.2%. Next year.
Yeah, so it should be in the range of 6 to 7%. We'll continue with that range.
6 to 7%. Okay. And then, if I may, the last one on the when you say this 24.5 to 25.5, would it be contingent on Goa plant clearance, EBITDA margin improvement?
No, this is not contingent on Goa plant clearance.
That should provide an upside if it happens, right?
So yes, certainly there could be some up, but we if
it depends on the timing of the inspection, right? Completely, because if the timing of the inspection is later in the year, we are unlikely to receive any impact out of this. If it's slightly earlier in the year, again keep in mind the 90-day process, post-inspection, and then the file movement, right? So you could actually say that after the audit, it will still take about 3 to 6 months for assets to start getting cleared. So it completely depends on the timing of the audit. But as of now, we've assumed that this only will come in the later half of the year. The asset progression will start only in the later half of the year.
Sure. And the last one on the generic Advair filing. So, between Indore and the new line that we have put up in US, which in your view would be faster, and when are we putting that launch into our future framework?
So I think we are hoping that the batches in the new site can happen, can start since we are already at the feasibility stage. And I think the timing will start from there.
Okay. And when are we putting it as a broad range or?
I'm sorry?
In terms of launches within the next 3 years, where it will be in the third year, second year?
Well, I think if we have a good shot at launching it towards the end of this year, for sure. Fiscal year for sure. I think that we have a good confidence of doing, but depends on the line.
Okay. Thank you and all the best.
Thank you, Anna.
Thank you. The last question is from the line of Alankar Garude from Kotak Institutional Equities. Please go ahead.
Hi, thank you for the opportunity. Sir, when you talk about increasing share in albuterol and lanreotide in FY25, are you factoring in incremental competition in both these products?
Yes, like whatever new players are likely to come in, we are cognizant of that, and with that we are aiming to increase our market share.
And in both these products, right?
Yeah, so albuterol, we've already in April seen some growth like we've suggested. From 12 to 13%, we are at about 15%, and we see that trend of going up continuing.
No, I mean in terms of facing incremental competition, that can be expected in both the products, right?
No, so albuterol has got all your competition already in the market. So we don't have any incremental competition there.
Understood. And maybe a second question there, Ashish, I mean linked to the inhalation portfolio. Now with innovators lowering prices for out-of-pocket patients starting June, is there a risk to generic pricing in both albuterol and maybe Advair later on? And conversely, I mean, if there is a possibility of lower rebates, can that actually lead to higher generic share for some of these inhalers?
So in case of Advair, we've already seen the market over a period of time to have come down the size. So I don't think it will go down further. And Umang, you may add if you have any perspective.
No, actually the other trend may start. If the rebating is lower, then actually the generic share would go up. So it could go either way. It's not necessarily that the generic is today in a category like Advair still only 50 or 60% of the market with two or three players already, right? So we think there is volume play there. On albuterol, really, I'm not sure we are looking at significantly increased competition, at least in the category that we are playing in.
Thank you. That's helpful. Maybe one last question with your permission. So you have been speaking about pursuing in-licensing opportunities within GLP-1 in India. Now, considering that there would be many more companies interested in such tie-ups, what would be Cipla's USPs here? I mean, in your pitch to these innovators, what would be the points for you to highlight?
So we have excellent in-licensing partnerships already and built over a period of time, and that relationship will definitely give us hopefully an edge over others. And we are a large player in the country. And at the same time, we are evaluating from our side all possible options, our own partnerships, etc., because it's a large opportunity overall that we would like to play in India.
Understood. That's all from my side. Thank you.
Thank you. Ladies and gentlemen, we would take that as a last question. I would now like to turn the conference over to Mr. Ajinkya Pandharkar for closing comments.
Thank you, Sagar. I thank you all for joining this call. If you have any further queries or questions, please reach out to investor.relations@cipla.com. I wish you all a very happy weekend.
Thank you. On behalf of Cipla Limited, that concludes this conference. Thank you for joining.